Here is a question nobody asks. If technical analysis really worked the way it is taught in books, why aren't hedge funds and institutions hiring chart pattern traders? Because they don't. And that's your first clue that the way retail traders learn technical analysis is, frankly, a trap. Technical analysis initially wasn't invented to help retail traders beat Wall Street. It was designed to make retail predictable. Institutions know exactly where the average trader will buy, sell, panic, or get greedy. And guess what? That's how they engineer price. They don't need your RSI or MACD. They need your stop losses or breakout orders. Once in a while, they will even let those chart patterns work, so people keep believing in the system. But the game isn't about triangles or flags. It's all about liquidity. Here is the reality. Smart money has orders so big, they cannot just hit buy or sell like you and me. If they did, the market would instantly move against them. So what do? They create fear or greed at specific price levels. Levels you probably recognize because they look like support or resistance, or some textbook pattern. Retail gets baited, they sell into fear, they buy into fake breakouts. And who is on the other side? Institutions, filling their massive orders cheaply, efficiently, invisibly. This is why most traders lose. They think they are reading the market, but they are actually being read by the market. So does that mean charts are useless? Not at all. The right way to use technical charts is not to predict the future. That's a fantasy. The chart isn't a crystal ball. What charts do show are the fingerprints of big money. When they move, they leave traces because their orders are just too large to hide. If you know how to spot those traces and you stop trading like the crowd, you can actually become profitable. But you need rules, you need patience, and you need to forget the idea that indicators or patterns will magically tell you what is next. Because most of the price action that matters, it happens inside the last 10 to 20 months. The rest of the chart history. And old history is one of the easiest tools for manipulation. They know you will mark those levels, so they use them against you. That's why every time you think support should hold, price slices right through it. Or every time you think a breakout looks clean, it reverses in your face. That's not a bad luck, that's design. So if you take anything from this video, let it be this: stop treating charts like fortune tellers. Start treating them like crime scenes. Look for traces, footprints, manipulation. That's where the truth is. Over the next videos, I will show you exactly how institutions manipulate price on the chart, and more importantly, how you can avoid being the victim.